Interest Rates and Forex, by www.theforexnittygritty.com. Interest rates and Forex are commonly intertwined. Investors will commonly move assets to currencies that pay higher interest rates. Japanese interest rates and Forex trading of the yen were a case in point for years, as many practiced the yen carry trade. The idea was to borrow money in Japan at extremely low interest rates and use the borrowed yen to buy dollars, euros, Swiss francs, British pounds, Australian dollars, or Canadian dollars. Then the investor used his new currency to buy U.S. Treasury bills or enter into some other higher interest-paying investment. We saw the flip side of the using of interest rates and Forex trading when Japanese companies and individuals began yen repatriation in order to pay for the costs of dealing with the historic earthquake in that country. Using interest rates and Forex trading to profit is common and does not require the yen carry trade or any variation. Countries where government bonds, corporate bonds, and banks pay high interest rates often attract foreign capital. When investors use their currency to buy the currency of the country with higher rates, they drive up the price of the other currency. Forex traders can profit from the situation merely by trading Forex. They do not need to make investments in the other country. How to trade Forex and interest rates is simply keeping an eye on the technical and fundamental factors that tend to predict changes in interest rates in order to buy and sell foreign currencies. A current example of how Forex and interest rates relate is the fact that recently the euro strengthened on the assumption that the EU will be raising interest rates. Although it is investors buying euros that drive the price up, traders speculating on the price of the euro in other currencies play their part as well. Investors as well as traders will drive up the price of the euro so long as buying is likely to lead to profits. For the investor, it has to do with whether the rise in the euro makes buying it prohibitive. For the trader, it simply has to do with how the market is likely to react and where prices will turn around. Because central banks are instrumental in setting interest rates, the actions of the U.S. Federal Reserve and central banks such as that of Japan are watched carefully by Forex traders. Just as the Federal Reserve buying gold and currency can affect Forex trading, so are Forex and interest rates set by the Fed crucial to trading the dollar. An overriding factor now in the Forex markets is the yen and the drawdown of Japanese offshore assets. However, that situation will eventually stabilize and traders will resume their normal routine of watching the pronouncements of the Fed and various central banks to help predict just where interest rates are heading. Interest rates and Forex are always related, and those who most accurately predict where rates are going have a distinct advantage in the Forex markets. For more insights and useful information regarding the Forex markets and foreign currency trading, visit www.theforexnittygritty.com.